Hi, welcome to CommodityRA. The nearby regulatory changes on Indian derivative segment is all about strict margins. Earlier, the broker used to provide extra leverage on exchange margin. That is a leverage on leverage, which resulted in sometimes broker default and unhealthy market mechanism. That has been stopped now. NSE has halved the lot size of around 40 securities from April 2021 onwards. But even though, as a futures trader or as an option writer is concerned, margins are high. How to overcome this situation? Is there any panacea to trade with less investment in derivatives? I'm going to tell you about that. Let's log into our platform first. And this trading signal will provide you algorithm-based result signals on futures price. These signals can also be used to purchase option contracts. There are three types: plain futures, buy single options, and futures with option calls. 70% of signals are intraday in nature, and very few will hold for a day or two. Let us take the example of HDFC Bank. The right panel, this is the right panel and this is the left panel. The right panel showing the generation time, I mean the time of the signal generation and the contract period, signal number and type. There is two types, one is trend reversal and breakout. And strategy, RSing methodology is owned by CommodityRA. If you want to know more about RSing methodology, I have posted another video in our channel, just watch it. Strength of the particular buy or sell, that is it showing. Even though if it is narrow, you no need to worry, because in a trend reversal normally the strength will be initially weak, gradually it picks up. And this is volatility. In the right panel you can see entry, that is the entry level where you supposed to be nearby this level, and stop loss levels. Target 1, target, first target, second target, and return is nothing but if you hit this target 1, how much money I can make for one lot. And this second thing is, if you hit the target 2, how much money you make for one lot. A risk is the money you may lose if you hit the stop loss for one lot. A margin is the amount required to place one lot future contract. Now let us take the three signal conversions. Plain futures trading call. The same thing which I shown here has been converted into a full-fledged trading call. Here you can see the risk return figures and stop target, everything whatever I placed here, it is there. Now you can adjust the lots. Here you can change the lot size, one lot, two lots. So correspondingly the margin and return risk figure also will change. If you are comfortable with the trade, let's see, one lot or two lots, just place order, send orders to Zerodha client. You can send orders as a regular order. When you place a regular order, only the entry price will go, or as a bracket order. When you place bracket order, the entry price and target and stop will place. Just click it here. While sending orders to brokers, you only need to log in initially, and the re-login requires only when the session expires. This I already logged in, so it is not necessary to log in again. You have option to modify here, and this is showing the trading symbol 1425.50, the entry level which we have decided in our signal. 1442.7 is that first target, because we have mentioned this is first target. This is the first target we take. If you selected second target, 1462 will come here, and 1408 is the stop loss, 08.6, that is mentioned here. And just is for one lot. I have selected only one lot, so it is showing only for a lot. If you selected two, it will show two lots here, quantity. So just place the order here. That order go to Zerodha platform. So just I am cancelling the order here because it's only a demo order. Now let's see the margin here. The margin is 1,65,900 rupees. It may not be comfortable for some traders. So for a reduced investment option, what we do? Normally we buy options. So we go for that option, buy single options. Before selecting buy single option, why only buying options and which strike we select? Before answering both the question, let me explain some option pricing basics. Option pricing is decided by three factors. Number one, underlying security movement. That is why I mentioned here. Underlying securities, the spot or futures. We cannot predict it. Even though I have predicted here with a stop loss, this is only a probability. And number two, implied volatility. Current volatility, in simple word we can say in the market. If you want to know more about implied volatility, I have posted another video on implied volatility. Just watch it in our channel. This implied volatility, 100% we can calculate. And number third is time decay. It is the loss in value for buyers and gain for sellers with days passing. This time decay also can be calculated. I have already told most of the signals are intraday or more than for a day. Such a scenario, time decay won't affect us more on our signal because we normally end the trade within a day, same day or for the next day. So there won't be much big time decay for us. So the entire play is in our signal is with IV or implied volatility. Again, let me ask one more question. If future price is moving 100 rupees up or down, whatever it is, how much option price will move? The answer is deep ITM option, that is in the money option. Deep in the money options will move almost the same or better than what future price will move. But the deep out of the money option, OTM option, won't move at all or may move slightly. And at the money option, ATM options will move around 50% of the future movement. It's around and it is only approximate. On default, our signal take ATM options. We normally don't go with ITM or OTM option. We trade with ATM on default. Why we are using ATM option? Since I already told the movement will be approximate 50%. So we will get around 50% of the future result. And number two, ATM contracts are mostly liquid, and liquidity is an issue with the option contract. And number three, ATM premium are reasonable. So now just select buy single option here from the list. We selected plain futures. Now second is buy single options. The entire future signal has been converted into an option trade now. And this is the strike price 1420. So why we selected 1420 as the strike price? This is 1425 the entry level. Nearby that we are taking as a strike price. It is converting the entry, target 1, target 2 and stop, which is mentioned here also, has been converted as an option levels using option pricing method. And premium, how much premium? This is the investment in option buy, how much premium you need to pay, and the return and risk figures as same thing as mentioned here. You see here the target one 17 rupees, it is predicted here, but when it comes to option it's only moving 7.96 rupees, and here it has predicted 36 rupees. We are expecting only 21.4, and when the stop hits 16 rupees, we are hitting with the 10 rupees. So this is because it is yesterday's call and 1 day pass. Here another important point is this amount entry level 47.73. This is not the current market price. Even strike price you can change if you want to change it, and you can take other strikes also, because by default we are here. Just take and select. Before taking a decision, just check the current option price. Just click trade button. Open. If derived option entry and the LTP are nearby, here it is nearby 47.73 and the market price around 48 point. There is no much difference, so you can go ahead with this option. Sometimes if it is too high, when the LTP may be too high compared to the derived option price, that means as we told, our price is mostly affected implied volatility. The volatility is so high, that is the reason the prices are high. So when it is the difference is so huge, better not to go with such an option trade. Here is the third option. The third option is futures with option hedge. Earlier we dropped the idea of trading futures due to high margin. We have seen 1,65,000 as the margin. But here you are trading the futures. You are trading the futures. It's selected here. But at the same time you are buying in opposite positions. What is opposite position? For a buy call on futures, buying put option is the opposite option position. And for a sell call on futures, buying a call is the opposite position. Here also our signals will prefer ATM options on default, because when you trade, always our system will take ATM options. So what happens when you trade opposite options as a hedge? You can change option and strike and entry as mentioned in buy single option. That whatever I mentioned for the buy single option is applicable here also. Just see the change. Your future margin, which was around 1,65,000 earlier, has been reduced to 27,000. So you have buying future margin here and option premium here, both added 50,723. So investment has reduced several times here compared to the future margin. And your risk level also, risk level was 9,000 rupees, has been reduced to 5,681, because when you make money here, you lose money here. When you lose money here, you make money here. This is for hedging. Since if you are using option with futures, when you correctly selected, you will make money when the trade go with your predictions. This is what the advantage of buying futures contract with an option hedge. Just like the same, you can also regular order and bracket order. There are two orders. One is a future contract, the other one is an option contract. So you need to place option contract first, because then only you get the benefit of a hedging margin advantage. One should understand these are approximate figures and monitoring is required always, but it is helping one to generate a standard returns on a portfolio. So how you build a portfolio, there is something called portfolio builder. So you go with this and edit it here, and you select which are the commodities or stocks or indices you need. You select it and update it here. Once it updated, it goes to a system and you get calls only for such contracts. Last and final, you may ask a valid question: how much is the accuracy? Because this is a signal created by an algorithm. So the main important thing is the algorithm. So here something called analysis here and something past performance. You can see the performance records and individual records can be downloaded as a PDF. The moment it goes up, more the time, the records will be more accurate. The reason is, instead of getting 10 days record, 30 days or 60 records will a decent returns. You can see here. Tata Steel, let's take. See what is inside. You can see there what is there inside. These are records, particular entry date, exit date, entry level, exit level, and stop, and how much profit make. So these are about the accuracy of these levels. And understand one thing, we provide more importance to the signal quality and accuracy of our advisories, because I provide a lot of technology just to make trading easy and comfortable for a trader. But our first preference is to give quality advice. Now the last, how to subscribe. This work with both web and mobile. The same thing also can be downloaded from Google Play Store. Search for CommodityRA. You get our web app that can be downloaded and you can use in our mobile. So I invite all of you to go for a free trial and kindly provide your feedbacks and comments, and we'll see you there. Thank you. Thank you very much.